Welcome to a brand new show of Market Makers. It's that juncture of the market where a lot of debating will be done on the impact of US banking crisis. Crisis is not the word, but it is really the confidence which in last 6 to 8 weeks has got hit. For India, first it was when we saw sell-off in Adani group of stocks, and now globally, what is happening to the financial system per se. So what does that mean for India? Are we in for a scary repeat of 2008? If not, why? And if the similarities have to be drawn, what are the similarities? Let's take that conversation forward with Nilesh Shah of Envision. Nilesh, fantastic to have you back. Thank you for joining us. They say history does not repeat itself, but it certainly rhymes. Having learned from the 2008 experience, everybody's worried about 2023 again. Is the tape being replayed?
Thank you, Nikunj, and it's always a pleasure to be here on ET Now with you. Yes, I agree in the sense that it's pretty much echoing the same kind of sentiment, the same kind of noises that we saw in 2008. We're hearing something similar. Just that I don't think it's going to be as drastic as 2008. I mean, 2008 was a terrible year where I remember that the headline indices itself probably corrected by 60% or so from the peak to the bottom. So I don't think it's going to be as bad as that. Okay, and I clearly believe that a lot of the signs, a lot of the kind of playbook is already evolved and it's already out there. So I don't think the impact is going to be as bad as that. But having said that, could we be in for some more extended period of consolidation? Quite possible. That's quite possible. We really don't know. I think the biggest uncertainty is still going to be about what US Fed does. What is the stance of US Fed on both liquidity and rates? And that's going to decide whether for the rest of the year we are going to have a risk on trade or not. I think that's the key variable. Otherwise, I think there's really nothing much else to worry about, especially from a point of view where the markets are today. I think from that context, I don't see there's too much reason to worry.
Nilesh, I distinctly remember the subprime crisis started in 2007. When it started, financial market watchers, they coined a term called decoupling. In 2008, they realized that it's a flat world and everything in a sense is joined at the hip. What are the chances that right now what appears like a storm in a teacup actually in hindsight will be much bigger than what it is right now?
Well, it could be a tad bigger because, whatever challenges that we have faced, especially what have come to the fore in the course of last maybe 3 to 4 weeks, both in the United States and in Europe, that's something which could pretty much catapult into something which is much bigger than what it is even today. But will it be like 2008? Very unlikely. I probably think it would be more like 2013, which was obviously not a great year. It was actually a terrible year, 2013, but was not as bad as 2008. So I probably think that 2023 could be more like 2013 and not like 2008. I think in 2008, you actually saw a huge, massive global sell-off, capitulation, and the damage was huge. I mean, we've never seen indices go off by 60%. I don't think we're going to see anything similar like that in 2023.
Okay. Now, post 2013, we saw a rally in mid and small cap stocks. Mid and small cap stocks have done rather poorly, if I say, the last 2 years.
Yes.
So, if you're of a 2013 kind of a scenario, could the reflation trade be there in some of the mid and small cap stocks?
Quite possible. And what you could see is that some of the mid and small caps could probably still gravitate a bit lower from where it is today, especially depending a lot on what the US Fed does in terms of interest rates, because that decides the risk on trade or not, whether we are in risk on or risk off. But assuming that they do correct a bit more from where we are today, I clearly believe that going forward from 2024 onwards, you're going to see a massive reflationary trade happening in mid and small caps. Valuations as it is have become reasonable. With a bit of more correction, they become even more attractive. I think the pressures in terms of raw material prices, input prices, they have started to abate. We're seeing crude from $140 down to $70 a barrel. Interest rates probably have peaked, at least in India, they look like having peaked. The Reserve Bank of India has been saying that the inflationary pressures are behind us. In fact, there's a stability report of theirs where they've reaffirmed the growth for FY24. So I think fundamentally, we seem to have hit the bottom, fundamentally. If prices were to correct a bit more, especially on the mid and small caps because of global reasons, I think we're set for a very, very strong rally in 24. The other thing which there may not be a causal effect or a cause and effect relationship, but 1 year prior to the general election in India is typically not a great year. Rewind, 2019 was the election year and 2018 was not a great year. Rewind further, 2014 was the election year, 2013 was bad. 2009 was the general election, 2008 was bad. 2004 was the general election, 2003 was bad. Fast forward, 2024 is the election year, we are in 23. 23 for now at least is not looking all that great. Okay, so I think investors with a 1 year plus horizon and with the conviction in India's potential, I think will be hugely rewarded 2024 onwards.
So since election is something which nobody's talking about today, but I'm sure 6 months from now, everybody will talk about elections. And when you are moving into a new election cycle, 6 to 8 months before that, the curiosity, the nervousness, the commitment always goes down. So what are the chances that next 6-7 months, by the time global markets recover, Indian underperformance will continue because of the general election cycle?
I wouldn't rule it out. Though I don't believe that India will underperform. I probably think at worst case or a base case scenario, India will probably be in line with global markets or in line with emerging markets. But I don't think that India will underperform because things like financial stability, inflation, the macros of India are a lot better than where they were in 2013 or 2008. See, mind you, in 2013 and 2008, we had huge challenges of inflation. Today, at least, our inflation rates are not way higher than what it is the world over. If at all, it's actually been lower and managed reasonably well. Actually, hats off in the way our macros have really got managed. So kudos to the entire team out there from the government and policymakers side. So I don't think it's going to be worse than global markets. It probably could be that India would fall or correct or consolidate in line with global markets. And then after that, I think come the end of this year, the start of next year, 2024, you're going to see a huge outperformance coming in from India because again, all the positives will come back, the world gets into a risk-on trade, and India is going to be the dark horse.
Let's divide the market in three time phases: 1 year, 3 year, 3 year plus. What looks good and attractive for 1 year, 3 year, and 5 years?
I think, Nikunj, from a 1 year perspective, the large caps look good. Okay. I clearly believe the large cap. Buy the Nifty or buy a basket of maybe 5 to 6 stocks in the Nifty, and I think they all have come off on an average by about 25%, 20 to 30% from their peaks. Maybe the room for them to fall further could be 5 to 10% because you can never say where the bottom is. But I think from a 1 year perspective, I think that pack will do extremely well. Okay, so I think from a 1 year perspective, I think that's the space. From a 3 year plus perspective, I clearly believe that the mid caps and small caps will essentially are going to beat every asset class globally and in India hands down. So I clearly believe from a 3 year plus horizon, I think mid to small caps look really well poised for a big outperformance.
5 year plus?
Hard to say, but I think 5 year plus, I clearly believe that in a bull market or an upcycle, the mid and the small caps will outperform. And this has happened always. And so if you ask me from a 5 year plus, again, it's going to be largely mid and small caps, which will do extremely better. Now, you could, when I say mid and small caps, it could also mean a bunch of stocks which today are probably hated, are large enough, but you can't call them as mid and small caps because the capitalization is a bit higher. But for example, some of the stocks on the online side, which had IPO'd in 21, I think from 5 years from now, these could be hugely profitable companies and they could be a lot more valuable than where they are today. So it could be a set of stocks which are either hated today or are doing well but are still mid and small caps. So from a 5 year perspective, I think that's the pack which will do very well.
Okay, so I go back to the beginning of the question, 1 year. 5 to 6 large cap stocks. What would be the combination here?
It would be a combination of, say, for example, I think Reliance Industries, which we own in our PMS. I think Reliance Industries looks good at this kind of price. From 2,800, it's probably down to 2,200. But I think,
it's underperformed. Even at 2,800, it's underperformed, I think, from last 2 years almost.
Yes, it's underperformed. But I think over the next 1 year plus, I think currently it's underperforming also because it's announced a capex plan. It's announced a borrowing plan, and the street tends to take all of these with slight bit of negativity or bit of caution. But I think it's there pretty much in the price. So I think that at this kind of prices looks good. I think the HDFC Twins, I think they look good. especially post the merger. I think they should look good. So that pack looks extremely good. You could even kind of say ICICI Bank or anything like that. I think some of the defense names like Bharat Dynamics or Bharat Electronics, some of these names which I'm taking, we own in our PMS. I think these kind of companies they look pretty good. I think from at least even a 1 year or even from a 1 to 3 year perspective, these kind of large cap names look good. Some of the names in the insurance side, names on the mutual fund and asset management company side. I mean, we own HDFC, AMC. I mean, yesterday it was trading at 25 times trailing earnings. 25 times trailing earnings for a business where the penetration is just about 2, 3, 4%. You're going to see more and more people and investors come in and participate in SIPs. And a business does not need capital. On a base case, this business has 10 to 15% likely earnings growth, or 25 to 30% return on equity. So highly capital efficient business, and a business which could keep growing for the next 5, 10, 15, 20 years and trading at 25 times trailing earnings. Okay. Probably the peak was at 50 times trailing earnings versus that is 25 times trailing earnings. I'm saying these kind of stocks look extremely good. They may not create fireworks for you, but would they be good place to be in from a 1 year plus perspective? I think so.
The anchoring for portfolio is also a function of the macro conditions. If interest rates are low, if commodity prices are low, these are perfect conditions to buy into small and mid-cap stocks at a bit of a beta. If inflation is high, if interest rates are higher than historical averages, it's time to buy defensives and where you can protect your money. What should be the anchoring of the portfolio?
See, my view is that at this point of time, it may not be the best place to go into defenses. When I say defensive, we're probably referring to FMCG kind of a pack, or maybe the core pharma pack. This is traditionally what we have called as defensive.
Maybe IT also.
It might be IT as well. But Nikunj, what I think is that maybe the macros in terms of worst, they have probably peaked out. You know, if at all going forward, I would probably think the probability of a rate cut is way higher than a rate hike. Okay, so to that extent, I honestly don't think this is a great time to be yet in consumer place. You may probably be there 1 or 2 names which you like, but I don't think FMCG is the place to be in. And purely simply reason because their growth from a volume growth will at best be 5 to 8%. Today, I would really kind of struggle to say that can a FMCG business grow in volume terms at 10% plus? Very unlikely.
They're growing actually lower than the GDP, so, to put it very simply.
Yes, so in the consumer pack, I think outside of FMCG, maybe things like alcoholic beverages, which we have been now liking for a long time.
But why were numbers for United Spirits so bad? If there's so much of commanding market share, the big picture that, you know, good or bad times, you will always consume alcohol.
So first is, I think, the industry-related challenges, twofold. One is clearly input prices. There's still kind of challenges there in terms of input prices. Cost of freight, cost of packaging, cost of bottles, cost of raw materials, all of that. Second is in some of the states have not yet given them price hikes. So these are two industry-related challenges. For United Spirits, which is a stock we own, they have challenges in terms of trying to reorient their portfolio, and they're trying to get rejig. So that's still work in progress. But I believe that they have kind of traveled a large part of that work in progress journey. And it's quite possible that maybe a couple of quarters later, you start to see the impact of that positively. The company in that space that we like even more is Radico Khaitan.
For almost a year now?
We've owned Radico Khaitan now for almost 3 years.
3 years now.
And it's been honestly so far a great journey with Radico. And we still think it's still early days for the entire industry and for a player like Radico Khaitan, which is a challenger to the two big giants in the space.
How come you didn't buy Sula? Only a whiskey, beer, not dwelling on wine?
Nikunj, we are looking at it. It's IPO'd very recently. We are still kind of looking at it. We'll probably kind of spend a lot more time, take a more harder look, and then take a call. But the space is interesting. And therefore, Sula also falls on our radar. But, you know, we haven't yet taken a decision. I guess we're still very early in our research process as far as Sula wines go.
I have to ask you IT before I get into specifics of your portfolio. It's a season of change in IT. Macro changes, layoffs by big tech, and if that was not enough, change of top guard. Infosys has lost talents. TCS, Rajesh's exit. I read that Mr. Desai from Mastech has decided to pursue different roles in the company. What do you want to start with? Macro, layoffs, or change of guard?
I think Nikunj, the macros and the layoffs affects them a lot less. You know, these are pretty much steady state, like the way we alluded to FMCG companies growing in mid to high single digits. I think the large cap IT companies will still kind of have that kind of growth.
8-10% growth is here.
8-10%. I mean, if I were to kind of just, and I'm taking Infosys as a reference point, even in the best year, which was financial year 21-22 for the sector, their earnings growth was only 16%. In your best year, you're going to grow 16%. Okay, so I think we have to keep that in mind, that they will probably just grow in a range of about 10 to 12%, depending upon how your operating parameters are. So I would still think that, and the large caps have played out. We've seen a huge rebound. So if we look at it probably sometime later, last year in 22, or the start of this calendar year, the IT stocks were on the lower side. I think we've seen some kind of a rebound trade. I think we're done with that. I don't think from here they can outperform in any significant manner, the large cap kind of pack. I think in IT, I still believe that the change and the delta, and therefore the alpha, will come in from the tier 2, tier 3 names, the mid to small cap names. There they have very interesting opportunities. Somebody is getting into new niche, somebody is getting into new geography, there are client wins, a new CEO, new leadership team.
What do you like?
These are the kind, well, we own only 2 stocks currently. We own in fact only one stock which is called LTTS right now. And that's about it.
You've sold Tata Elxsi completely?
Yeah, we are out of Tata Elxsi. Okay. So we're going to be evaluating. I think we're going to take 1 or 2 more quarters. And I think in that environment, we will come up with extremely good ideas. But see, a name like Tech Mahindra, which is large cap.
Change of guard there. Yeah.
But I think there's a change of guard. Somebody with strong credentials is really coming in out there. It's got the pedigree of the M&M group. The group CEO of M&M has been very aspirational and is really driving individual operating companies really hard. There is a change in leadership for Tech Mahindra. Size is great. They have very minimal exposure to BFSI. They are in communications and telecom and all of that. So that's one company where we haven't invested yet, but I think we would want to be watchful. We would want to see what the new CEO has in store in terms of his aspiration, his strategy, and all of that. We will see and we'll evaluate and maybe take a call there. So that's like one of the names which is part of our prospect list, but is not yet in the portfolio.
But this is the lowest positioning in IT in your portfolio as a weightage?
Yes, absolutely.
You're supposed to be the IT guy.
Yeah, but I think
anything in IT, go and ask Nilesh.
I think in Nikunj in 21 and some bit of early 22, I think we had a lot of excesses in IT. Okay, I mean, look at the excesses that we saw in names like Tata Elxsi and Persistent.
60 times, 70 times.
I mean, all of that. Okay, and so I think the markets had priced in as if the margins that they were reporting and the growth rates that they were reporting will continue for very extended periods of time. I don't think so, because our IT companies are services companies. These are not product companies. Again, within technology, maybe some of the SaaS companies, we don't own any of the SaaS companies yet, but I think some of them also might look very, very interesting. Some of them have come off by 60% already, 50, 60, 70% there's been a shave off. Maybe some of them become very, very interesting.
Nilesh, if someone bought, I was too young that time, but the old timers tell me that in 1990s, if you bought consumers, Nestle, Colgate, HUL, you pretty much got the theme right for next 20 years.
Yes.
If somebody is buying a Zomato or a Paytm or a Policy Bazaar, are these the high growth companies of the next 1 decade?
Undoubtedly, yes. I think these are essentially what we used to in 21 call hyperscalers globally. I think these are going to be hyperscalers of India. Okay. We probably just own 1 or 2 of the names that you've taken.
You own Policy Bazaar. You've gone
we've owned Policy Bazaar. It's amongst our top holding, and we've been constructive on it because we've clearly seen people are talking about part 2 profitability and all of that. But I think here there's a very established part 2 revenues because of the repeat premiums that get paid by policy holders. So yes, but clearly I think these are businesses which are addressing a huge opportunity, a humongous opportunity. And things like consumer demographics, digitalization, online technology, all of them, I think are powerful tailwinds which each one of these businesses enjoy. And I think wherever you can clearly understand the business model and see how things are going to unfold in the next 3 years, 5 years, 10 years, and you see a part 2 revenues, part 2 profitability, I think that's the time to really act on them. So I clearly believe that investors would make a serious mistake by not looking at them and taking their eyes off them. I think one should be constructive on them, because the winners, people who bought like what you told in the 90s, the HULs and the Nestles and all of that, took a view how these businesses will shape up in the next 5, 10, 15, 20 years, not about how the next one quarter or the next 1 year is going to be. I think we will have to look at these kind of businesses from a similar lens. So if there's one area which I think in the next 5, 10, 15, 20 years which can do really well are some of these companies which listed themselves in 21 and are essentially consumer companies using technology to basically penetrate and grow their businesses.
And their market caps already, and purely forget the path to profitability, the market caps, the starting point. For Zomato, I think it's $6-7 billion.
Yes.
For Policy Bazaar, it would be
currently about $3 billion.
$3 billion.
Around $3 billion.
Paytm would be nearing $6-7 billion, maybe more actually.
Yes.
I'm not looked at the last number.
Yes.
But my point is that if the starting point is today, then you're buying these companies not at the valuation, not at the market cap of small cap. You're buying them pretty much as mature mid cap companies. So they cannot be multi-baggers. They can be compounders.
Yeah, they can be compounders. But over 10, 20 years, if something compounds in high double digits, you could call them as multi-baggers, which means that if a business, for example, or a stock delivers you a 20 to 25% annualized return over a 10-year time frame, they end up becoming 5 to 10 baggers over a 10-year time frame.
I'll just give this maths to our viewers. HDFC Bank has multiplied at 20% for 20 years. In 10 years, they become 10x, but they've compounded for another 10 years at 20%, that makes it 100x in 20 years. Now that's the math which is called as power of compounding. So if I have to put a lesson in this edition with Nilesh, power of compounding is the most important aspect which you really need to look at when you are starting your investment journey. Nilesh, now let's look at Policy Bazaar. He was part of a show called Class of 21. And he's gone on record to say that, look, I'm aiming at a profit of 1,000 crore by 2027. Official public information. Which means if I look at the current market price divided by the guidance what the management has given, we are looking at a stock trading at about 40-50 times, about 50 times FY27. So growth is great, but the markets are making the stock trade at 50 times FY27. So where is the margin of safety for you?
I think Policy Bazaar, if you really look at it today, the market cap would be, I think, about 25 to 30,000 crores. Okay. So if I were to look at FY27 and the guidance which the company has dished out of 1,000 crores PAT, it's trading at 25, 27 times FY27 kind of earnings. Now there are two things. One is that the end of the journey? Answer is no. I clearly believe that that's probably only the first milestone which a company like that has in a marathon which could last for several decades. So my view is that could just be the start, number one. Number two is, my view is 1,000 crore PAT in FY27 is to me a base case scenario. I probably think that they might achieve that maybe even a year earlier, or they could exceed the 1,000 crore number by FY27 too. Third is, in this market cap, they have about 5,000 crores of cash. Okay, so if you kind of look at it from an enterprise value perspective, strip off the cash, then it's even more attractive.
Yes.
And my view is that
they may start giving dividends. They may start
doing dividends, buybacks, all of that. They have clearly stated that they are not the ones who will go out and buy businesses so far. They prefer to build business rather than buy business, and I like that as an attribute. I see that as a virtue of a management quality, that you're willing to build a business. In addition to that, we always look at PB FinTech from just an insurance point of view, which is rightly so. Majority of the value today comes from insurance. But there is the credit business. I mean, that's a 100 lakh crore market, okay, which they can probably try and address. In addition to that, they have got in principle approvals to start the account aggregator business. That itself, according to me, is a game changer in India's journey of financialization. They have got approval for being a payment license or a payment aggregator. So they have a few optionalities of which today we don't know. Today it's just looked upon as an insurance company.
Distributor,
okay? A distributor of insurance. Then you have the distributor of credit. And then you have these 2-3 optionalities on which we may get a better color only sometime in the later part of this decade, which can be the growth drivers probably for the next decade.
So you're buying Policy Bazaar not because it's BFSI space, but it is a play on tech and growth.
Yeah, I mean, first of all, it's a play on demographics. I think Indians
it's a consumer bet.
Absolutely.
It is not IT or it is not a bet on BFSI space.
Absolutely. I mean, I think the mistake which most of us, including myself in the 90s, made was to look at HDFC Bank as one more bank.
It was an FMCG company.
It was actually a consumer company. It was targeting salaried people. It was targeting savings account. It was targeting credit cards. It was targeting ATMs. It was using technology. to essentially gain market share.
So don't buy it from the prism of that typical price to book, and that's the mistake one should not do with some consumer tech.
Absolutely.
Okay, I'll wrap it up with one final question. And you've owned HDFC AMC for a while. I think it's been a holding which is pre-COVID.
Yes, that's right. Maybe 3 to 4 years. Okay. Yes.
The mechanics of the AMC industry are changing.
Yes.
The commission structure is down. There is a case which the regulator has already made that the commission structure they need to go down. This is a competitive business. A PMS like you is challenging the incumbents here. More and more AMCs are coming. While the size of the pot is large, it's the fact that the TER and the margins are coming down.
Yes.
And if margins they go down further, it's a challenge for the industry. Why would you like to buy a business where growth is there, but profitability is getting compromised because of regulation and other factors?
Nikunj, I believe a lot of these concerns are in the price.
25 times?
I think 25 times trailing earnings for a business which does not require capital, which throws cash flows on a base case where it delivers you 25% ROE, and for a franchise like HDFC. Okay, I clearly believe that at 25 times trailing earnings, a lot of these concerns, a lot of these apprehensions are in the price. My view is that yes, when the news comes out in terms of a lower TER and all of that, you might see one more knee-jerk reaction. But I think after that, I clearly believe for the medium term, there are no more negatives. You could only be in for maybe some kind of positive surprises.
So Nilesh, we've started with global micro and we're ending with a view on AMC. Tell us your view about life in general. Now that you're back at office, COVID, the worst is behind us. Your son is studying abroad. He's finished his graduation.
Yes, he's finished. He's finished.
So अब तो life में responsibility नहीं है, right?
Yeah, in a way, yes. In the sense from a work-life point of view, yes. I think one is back in terms of the balance. I'm glad we are back to the normal times. One gets to now travel for work, travel for vacations, all of that. So I think, yeah, it's one couldn't ask for more.
So what is the tip, not a stock market tip, but a tip of life from Nilesh Shah? You've been reading a lot, so let me ask the philosophical side now.
I think to me the only thing is that your work should be your passion and your passion should be work. I clearly think that's the only way to enjoy. I think if you get this, then the concept of work-life balance doesn't exist, according to me.
Nilesh, we've been friends for 2 decades now, and my condolences. You've lost your mother. I had a fortune of interacting with her. So my condolences. A loss of parent, what I've suffered is something very tragic. But that is life. So my sincere condolences once again.
Thank you.
Thank you, Nilesh. Thank you for your time and hope to see you once again.
Thanks.
That's it on this edition of Market Makers. Thank you for joining us.